All right. Well, I'd like to welcome everybody to our first of what will be a number of CEFA webinars that we are starting for the Southeastern Alternative Funds Association. I'm delighted today to be joined by our first guest, Kim Flynn, who's the president of XA Investments out of Chicago. Today's topic is success strategies in the interval fund market, particularly for alternative managers who are considering setting up and launching a registered fund, an interval fund, or another version of a closed-end fund. So Kim, we're delighted to have you, and we have a lot of great content that we want to get through today. What I'd like to do is allow you to maybe give a little bit of background about yourself and XA Investments. And then I think we'll start at like sort of a 101 level about what are interval funds, why are we hearing a lot about them in the context of alternative managers and private wealth, and much more. So with that, Kim, thank you for joining us today on our webinar, and I'll let you go ahead and give some background.
Great. Thank you, Andres. My firm is a Chicago-based asset manager, and we have a listed closed-end fund. We also have an interval fund. We work with outside asset managers, so we hire sub-advisors. And through that sub-advisory practice, we actually began to meet a lot of alternative investment managers, a lot of GPs, who were compelled to learn more about these product structures because there's such a great product structure for alternative investments or less liquid investments. And through that, we actually developed a consulting practice now about 4.5 years ago, where we advise GPs and alternative managers on how they too can develop SEC registered products that fit alternative investment strategies without diluting them, without changing them. So being true to the institutional strategy and maintaining the integrity of that strategy. And we've worked with a number of different clients, both alternative and traditional investment managers who are looking to enter the marketplace. There's a lot of talk right now about interval funds, but I think they're a fairly niche product structure. So not everybody understands what it means or how it might fit with how they run money.
Yeah. So, one of the missions and objectives of CEFA is to provide education, information, and sort of forums for the advancement of professionals that are active in the alternative investment industry throughout the Southeast. And we really appreciate you spending time today on this webinar to sort of provide that education about really what is the interval fund, what is the opportunity for asset managers, whether traditional or alternative. We have many of both that are participants in CEFA in our network. And so what I thought we could do is, before jumping into some of the things that you all provide to asset managers who come to you trying to understand the market and how to do this, is let's just sort of level set on the actual structure. A lot of the managers that run alternative strategies are doing it in a traditional closed-end fund, like a GP LP partnership structure, which is quite common. But this is a different vehicle. So maybe what you could do is sort of set the table about the registered fund. What does that mean? What are the implications?
Sure. So an interval fund and its sister fund structure, the tender fund, are both types of non-listed SEC registered closed-end funds. And they are part of this category of alternative funds that we call semi-liquid or intermittent liquidity. So investors may be able to buy the fund on a daily basis, but their opportunity to exit the fund is typically quarterly, and there is a limit. Because the assets within the portfolio are less liquid or entirely illiquid, something like private equity or venture capital, you do have to limit the percentage of the fund that can be liquidated at quarter end. And so all of these interval funds, the interval speaks to that window of liquidity, and they are a type of registered fund, and they share some characteristics with mutual funds in the sense that while they're technically called closed-end funds, they're actually open-ended, meaning that they're continuously offered, they're perpetual in nature, and they can be sold on an ongoing basis. And so you're having money come in and you're also having money come out. The money that will come out at NAV is limited to that quarterly window for liquidity. But the reason that these structures are really a good fit for semi-liquid or illiquid is that the portfolio manager knows in advance the schedule for that liquidity window and can plan. And so even if you're investing in something like private equity or private credit, typically you're holding a small portion of the portfolio in more liquid assets that can be sold to meet redemptions.
Yeah. So I think it would be helpful because when when we do content and put on events for CEFA, a lot of the folks that are participants, whether they're auditors or prime brokers or attorneys that do fund formation work, I would say the majority is around the closed-end fund structure, which typically comes with things like capital calls, maybe the subscription documents, the PPM, and it's effectively a partnership, right, between the fund management company and the investors. This is different. Clearly, you've said registered, you've said listed. There is an NAV in both vehicles. What are some of the big differences for the manager that's listening to this webinar or going to listen to the replay? What are some of the big differences that, as just an organization, that they need to really understand from the get-go about if they wanted to explore the registered fund versus a current fund that they may be in market with or that they currently manage that's closed in?
Yeah, I think the rationale for an alternative manager who currently runs private funds is that they want to diversify their revenue base. The interval fund vehicles are typically evergreen or permanent capital. So there's also a desire for alternative firms to create pools of permanent capital as opposed to private funds, which might have set termination dates. So it allows you to continue investing and deploying capital. And so I think there's a lot of advantages, but with a registered fund in particular, you're able to go out to a much larger retail audience. And so, with you think about the features of a private fund, you have typically subscription documents, you have K1s, and those are things that the retail investor is not used to. And so the interval fund solves for that because you're going to get 1099s instead of K1s. And to the extent that the fund is a daily net asset value type product, you don't have subscription documents. There's actually an electronic ticketing option. And so it's really for financial advisors who have started to use interval funds. It's a way for their clients to get access to alternatives because many of them don't meet the minimums that private funds impose. And frankly, they may not meet the suitability standards. A lot of the private funds are QP or accredited suitability standard. And so for financial advisors who have embraced interval funds, it's a way for all of their clients to have a small allocation to things like private credit, like direct lending or structured credit. And so this is really an opportunity for alternative investment managers to take their expertise to a different marketplace. Now, the typical buyer of an interval fund is like a family office or a registered investment advisor, an independent advisor. There has been some adoptions in the wirehouse firms, but most interval funds start in the RA or the family office channel.
Yeah, let's talk a little bit about, I want to spend some time on the webinar today talking about distribution strategies because the title of our webinar was Success Strategies for Alternative Investment Managers in the interval fund market. And clearly distribution, sales, capital formation in the private wealth retail market is a huge topic of critical importance. But I want to back up a little bit around some of the services and some of the work you and your team do at your firm around feasibility. So there's a lot that goes into exploring if this vehicle, if this market, if your strategy is a good fit. And I would assume that we could spend some time talking about distribution and spend a full 45 minutes talking just distribution, but I think there's probably other aspects that a
Yeah.
manager should be aware of. Things like costs and timeline and various vendors that need to be involved. So could we just take a few minutes and talk about what is involved when a manager approaches you and starts to think about, okay, I want to diversify my revenue stream. We want to get beyond just the private fund, closed-end fund space, and we want to go look at this private wealth space that's growing. What are some of the things that you're going to start to ask them about and talk about?
Yeah, I think for most alternative managers, what's top of mind is economics. They want to understand what kind of management fee they can charge. They want to understand what are the upfront costs associated with launching a fund like this. And ultimately, they're trying to understand the break even, because I think they understand it's a new market opportunity. There are going to be some upfront costs, and the scaling of a fund is really important in terms of the unit economics, and determining whether or not you break it even in year two, or if it's going to take you longer to do so. So we always start with economics, because that's very much top of mind for firms as they consider whether or not this is an opportunity that they want to pursue. And then ultimately, from there, we start talking about strategy implications. Do they have to make any changes at the portfolio level that impacts the investment team? Because a lot of firms have set investment philosophies and processes that there's a lot of integrity about those, and so to change something could be a major problem for the firm itself. And so I think those are the two pieces. Is it economically feasible, and is the portfolio management team going to be able to support the fund and still generate very attractive returns? Because you don't want to water down or change the strategy to the degree that it's something altogether different. Now, the retail customer is demanding, in the sense that they want your best investment capabilities, and they're going to want it, frankly, for a lower price. And so there's some tension in that. And so that's why we always start with those two main topics. We will often conduct feasibility studies because I think now that interval funds are growing in popularity, people have heard about them. I would say most of our clients don't understand sort of the process by which you'd go about building a fund. And so a feasibility study really gets all those questions and concerns on the table up front. We see a lot of competitors make the mistake of sort of hurrying up, getting on file with the SEC, filing a prospectus, and they waste a lot of money and a lot of time with a half-baked concept. And some of the issues that come up are maybe they're related to back office or operational support or valuation. And so it's really important on the front end to assess feasibility and determine if there's any showstoppers before proceeding, because these are not cheap products from a legal perspective to build, and outside legal counsel is going to be the biggest cost with respect to organizational expense. So it's really important, and we can help our clients go through the thought process on the front end to make sure that that they've gone through the checklist, and that they're comfortable that the product is a good fit for them, and it's a feasible strategy. And assessing the competition now that the market has grown is a really important part of that feasibility study too, because certain segments of the market, like credit, have gotten very crowded. There's now 70 credit funds out of a total of 220. So the need for product differentiation is really important if you're going into a more crowded segment of the market. Now, there are spaces where there's quite a bit of white space, which is a good news for alternative managers.
Yeah, a lot of the folks that have been involved with CEFA for many years know this, but there's an interesting factoid that I wanted to share today, in that the Southeastern Alternative Fund Association originally started in the late 90s as the Southeastern Hedge Fund Association. And I bring that up because we have a lot of folks that are still very active in the hedge fund industry. and whether that's managing capital or deploying capital and or supporting firms in that particular space. And so what I wanted to ask you, you kind of alluded to this just a moment ago, but I wanted to ask you about the size of the market. We do see that it's growing. One of the things we will talk about today is distribution and why interval funds and these offerings seem to be coming up more and more. And we're seeing more and more bigger managers in particular that are considering or bringing those out. But I want to go back to the hedge funds and the size of the market. You mentioned 220 funds that are in market. Could you just give us some context in terms of how big is the market? What are the different types of interval fund strategies or tender offer fund strategies? I know that the perception is it's for liquid or semi-liquid, or maybe even less liquid strategies. So I'd like to kind of put all those facts out on the table.
Yeah, let's start with hedge funds because there's actually been, I think, they've been sort of there. There've been a number of hedge funds that formed early on in the interval fund market history, and some of them were long short equity. Some were more derivative based strategies. But right now there's 30 out of the 220 that are considered to be hedge fund strategies in the market. I think we'll see a lot more hedge funds come to market, partly because it's the gatekeepers and it's the financial advisors themselves that are starting to express a preference for this structure because it's easier for their clients than a private fund. And so I think the hedge funds are starting to hear that this might be a better way to package the same strategy. And so, yes, hedge funds is one area where I think there is some white space. And now the reason that some of the larger, I guess, more reputable alternative managers and hedge funds that are now considering this structure is because we have proof of success. And so a lot of these alternative managers don't want to bother if they can't raise $1 billion or $2 billion. It's not worth their time or effort. But we now in this market have 30 funds that are north of 2 billion. So the number is even larger that are north of $1 billion. And that's growing. And it's a fairly democratic market in terms of the ability to raise capital. And I contrast it with the REIT, the non-listed REIT or the non-listed BDC marketplace, which some of the listeners might be familiar with, which the capital is being raised by a very small group of alternative managers, with Blackstone leading the capital raising efforts in the non-listed REIT, non-listed BDC marketplace. We see something altogether different, which is refreshing in the interval fund market, and the top 30 funds are the largest, and they're obviously attracting additional capital. But you have a lot of firms that you may or may not recognize their name. You have institutional consultants like Cliffwater, which are leading the market with their 20 billion direct lending fund. You also have a firm out of Portland, Oregon called Variant, which has niche income investments, and their single fund is north of 3 billion. So I think it is a fairly democratic marketplace for new entrants. And we're seeing right now, in terms of SEC registrations, we track a backlog of about 42 funds that are in the middle of that registration process. So a lot of really interesting funds that are going to launch later this year. And what's new and different that's expanding this market is things like secondaries, secondary dedicated funds. We've seen secondaries be part of private equity. Another category that's emerged is infrastructure, with people's concerns about inflation being top of mind. There are now 8 infrastructure funds. It used to be kind of rolled up into real estate, but now it's its own category. And I think we're going to see more hedge funds come to market and get into the pipeline. The biggest segments of the market, I've talked about it, it's private credit. And part of the reason why private credit is so large is, we're in a high interest rate environment, but these alternative credit funds, it's a variety of strategies, but they're all yielding anywhere from 10 to 15%. So very, very attractive yields. There's risk commensurate with the yield that you're earning, but very attractive to more traditional fixed income options. After that, the categories, the second largest category is private equity venture capital. The third largest category is real estate. Now, real estate used to be number 2, but as you can imagine, with some of the proration trends and the valuation markdowns in real estate, they've slipped now down to the third position. So yes, so the market, these structures can really hold any type of illiquid or less liquid strategy. And so, there's a lot of niche things as well, like insurance-linked securities, which is catastrophe bonds, things of that nature. So a lot of variety of alternative strategies that we're seeing in the market today.
Yeah, you're hitting on a lot of things that I would think folks that are listening, whether they're managers that are managing capital and are thinking about diversifying the revenue base, or conversely, they're investors and allocators, and they're at an independent RIA or a multifamily office or a single family office, and they're increasingly looking at different strategies. But now along comes a completely different wrapper, if you will, a different product type for those same strategies, which is increasingly making the due diligence process. You mentioned gatekeepers. There's now not only the choice in strategies from different managers, but a choice in, I might be able to get the same exposure and diversify the portfolio, but do so with a private vehicle or do so with a semi-liquid tender offer type of vehicle. And you mentioned this earlier, that some of the gatekeepers are starting to ask for these types of strategies. With that in mind, when you talk to clients that are trying to straddle both worlds or be in both camps of the institutional and the private wealth, you talked about table stakes and some of the folks rush to market and they're half baked with their offerings. How much time do you typically see is involved in kind of assessing the market, determining if there's demand, determining if you're going to get an audience with the gatekeepers before you go and spend, I would imagine, what is pretty significant amount of money, to actually support one of these funds, much less get it launched?
Yeah. Yeah, I let's start with the gatekeepers, because I attended a conference in Boston this week, and I got to hear from the head of due diligence at both Morgan Stanley and Merrill Lynch. And what was surprising to me was they said that all of the flows are going into the semi-liquid, so the interval funds, the non-listed BDCs, the non-listed REITs. And the reason that the flows are going to those registered structures is because they can be sold to a much, much larger investor audience. And the private funds are very limited. And sometimes within the wirehouse firms, the private funds have even additional suitability restrictions put upon them, beyond just what the fund docs say. So that's what's interesting about the gatekeepers. So even if they're not telling their GP partners, hey, you should go build an interval fund, when they're asked the question about flows, the flows are all going to these products that can serve a much larger customer base. So I think that the flows will have it in terms of where we see people spend time in terms of trying to serve different customers, because clearly institutions are going to want the private fund, but I think there's going to be a bifurcation within wealth management, because these wealth management firms want to see products that can be offered. And there's so much time for onboarding. There's so much time for due diligence, as we were just talking about in terms of the timetable. And so if these gatekeepers are adding a new fund, then they want to make sure that it's something that, they've all talked about the desire, and their research firms have put out target allocations to alternatives. But if they don't have products on offer that everyone can purchase, there's a disconnect. And so I think that's why they're trying to address it, because the wealthiest people in America have long had access to private funds. If you've got a
Yeah.
family office, they don't need the interval funds. They already have, and they're comfortable with K1s because they have an accountant doing their tax returns. So the process, I think you were asking me just about, we always say it takes a good 6 to 9 months to build a fund. And that's on a pretty tight timetable, because as you were indicating, I think, or alluding to, there's a lot of time spent on the front end, because a lot of alternative managers will approach us, we'll have an initial conversation, and I would say there's a whole 6 to 12 month of consideration, just internal dialogue and thinking about, getting up to speed on the marketplace before they're even ready to start the product build process in earnest. So that's why it can be a multiple year sort of thing. It's worthwhile for, alternative managers to kind of get smart on the structure, be tracking the market and the market growth, because when they are ready to build a product, maybe it's in 2025, it's still going to take them almost a year to get to market. The average fund spends 7 months in the SEC registration process alone. And that's just, it's a key part of the process, but it's just one element. It shouldn't take 7 months. We can help our clients be much more efficient with their time and with their money. And it's not actually the SEC's fault. I know we all like to blame the SEC, but a lot of fund registrants and fund sponsors are kind of shooting themselves in the foot, because they do go in half-baked and they start to learn things as time passes on, and then they make changes to the prospectus. And if you're making changes to the prospectus, it's going to basically bring on additional comments from your SEC examiner. And frankly, I would imagine that there's some irritation, because what the SEC examiner wants to see is only changes pertaining to their comments. Otherwise, you're keeping that examination process open and subject to further review. And think about it, and this is why we have a consulting practice, is because your law firm is not aligned with what's in your best economic interest. Because if you're changing things, the law firm's never going to tell you stop changing things, because the billable hours, that clock keeps ticking. And if you're changing your prospectus and you're getting 5 rounds of SEC comments, the lawyers are charging for that because it is taking their time. And so that's what we always try to align ourselves with, the head of sales, the head of business development, who's got a particular timetable and needs to manage the costs and needs to manage that timetable. So as if we were part of the internal team. And I think that's where we can really help people.
Yeah, it sounds like it. I was in New York as well recently, and one of the things that you're seeing, and this has been the case at larger asset management firms for some time, but you're starting to see a role proliferate at these alternative asset managers, and that's the product strategist or the product development team. And I think they sit between typically the investment team and the distribution team, and they're really trying to sort of keep a pulse on the story, the message, the marketing, the distribution piece, but they're also trying to sort of be embedded in the investment process to understand what's happening on the investment side, and what's working, what are the risks and challenges in the portfolio. I want to ask you about this product development background. You have a very deep background in product development at Nuveen, and you're continuing to provide that, it sounds like, to your clients. What is often overlooked in that role in terms of product development? Because I think a lot of managers often make a mistake and think it's all about numbers. It's all about performance, and my performance is going to sell itself. Or they think the returns are so good, or the yield is so attractive that people will buy it. What are they missing? So I want to talk a little bit about product development and what goes into that story, and what goes into developing the right features of the product, so that when you do come to market and you do kind of start those conversations, they don't fall on deaf ears.
Yeah, I'm smiling because the two biggest common issues that we see, and they're very telling, is we always ask, who are your competitors? Who do you think your competition is? Either in the private fund space or in the interval fund space. And I would say 80% of people say we don't have any competition, and they
Hmm.
do. They have
Yeah.
direct competitors, and oftentimes they have a lot of indirect competitors. So I think people have blinders on with respect to the competition, and that's the first mistake, because the second mistake that people make is they say, well, we have a great investment strategy, and this is kind of sort of the potential arrogance of the portfolio team coming through, which is that we do it this way and everybody's going to want it. And so an example of that would be, there's kind of these kitchen sink go anywhere credit funds where it's like the best of this alternative manager. And the reality is that at this point in time, the average advisor may or may not want everything. Let's say they're already invested in the Cliffwater direct lending product. So instead, maybe they'd like something that's complementary. Maybe they'd like a structured credit product that has different characteristics. Do they really need like a kitchen sink credit fund? And so just understanding who the direct and the indirect competitors that you're going to be up against in the sales process is really important. And I think sometimes, to the extent that in organizations that are very much driven by the portfolio managers, that can be tough medicine to swallow, right? Helping them understand that, yes, it's a great strategy, but it may or may not be competitive with, and it may not be something where you can raise a lot of capital. The other issue that we see is more operational driven. And I think some organizations, it's an afterthought to think about the mid and the back office support that's going to be required for a 40 Act registered product. So the operational team that's going to be involved, let's say you're doing a daily NAV. With your private funds, you're not likely doing a daily NAV. So that can cause a lot of process change. And so if the sales team says, hey, we're gonna get to a daily NAV, and they haven't talked to the folks running operational support, that's a problem. And that can be a show-stopping issue too, because, some of those processes, there's a lot of people involved, and then there's some automation involved. And so if what you're doing is slightly different than what you have done historically, you need to at least bring the operational team along in that process. And I think it's a bit of an afterthought, particularly for sales-led organizations who don't realize what's going to be required of the mid to back office. So those are the three things that I think people underestimate. These are complex product structures. FINRA considers them to be, because they're alternative, but they also have some complexity at the structure level. And so we think even with that complexity, it's worthwhile considering. The overarching trend is that institutional capital pools are shrinking. So it's going to behoove managers to think about how do they tap into the growing part of the market, which is the retail marketplace.
Yeah, and the retail market is very, very diverse, right? Just like the institutional market, where we have insurance companies and pension funds, DB, DC, we have endowments, we have, gigantic single family offices that are effectively large institutions. But a lot of institutionally focused managers also may not realize that the private wealth, or what Main Street or Wall Street refers to as retail, is also very diverse. So maybe what we could do is spend the last 5 minutes talking about the distribution side of the coin. It is a big part of analyzing a break even, right? Is how quickly, or what is the time frame and the resources to get to what that break even number is. So let's talk about distribution before we wrap up. Before we do that, what does a sort of reasonable break even look like for a manager that wants to set up an interval fund and, say, credit or real estate? What does that look like in terms of an assets under management that they need to be thinking about, with sort of market fees involved?
Yeah, we would suggest sometime in the second year. We always do a detailed economic model, and I would say that while interval funds, There is some legal expense in organizing the funds. A lot of fund sponsors choose to cover those costs and not put the organizational costs to shareholders. To the extent that a fund were able to scale very quickly, those costs could be, put to shareholders and paid. But so that's the question is really, it's about scaling and how quickly is the fund going to be able to scale, not only to cover its organizational expenses, but to cover the ongoing operational expenses. And a lot of the operational expenses, you're talking fund administration is a large expense, transfer agent expenses, and then once again, fund counsel expense. So those are the three largest ongoing operating expenses. But a lot of those fees do have sort of fixed minimum dollar prices, and then they go into basis point type fees. So because of that, we say the second year is sort of a reasonable expectation. Maybe it's early in the second year if you've scaled very quickly. Maybe it's in the end of the second year or into the third year, depending on how much in the way of fee waivers. So one of the choices that you have to make is maybe you offer a 50 basis point fee waiver. Now, some of the market leaders like Cliffwater have offered a 1-year full management fee waiver, but that's a way for them to accelerate capital raising. And so the critical issue, if it's scaling a fund, we always advise clients to think through how to raise the early capital and effectively avoid starting a fund at $0, because there is a natural chicken and egg problem for a young fund. And the investors that know you or that have had a good experience with you are more likely to come into a new fund, as opposed to a family office that has never heard of you, right? They're not going to be an early investor. So that conversation looks a little something like, do you have seed capital? Do you have lead capital? Do you have contributed capital? Could you raise a private fund and then convert it into a registered fund? And for every alternative asset manager, the options, while all of those things are hard, none of them are easy, certain options end up being better. So if you have a big parent, you can get 50 million of seed capital. If you don't, you're going to have to go raise it from institutional investors, who know you. Some people have legacy private funds. We've seen some success in the last 12 to 18 months with firms. Some of them have contributed more than one legacy or predecessor private fund. But there's a lot of effort to figure out how to start the fund, not at $0, but maybe at $50 or maybe even 100 million, because it's at about 100 million where a fund has sufficient scale to cover its operating expenses. And so that's really, the economics really hinge upon that. And I think the thing that surprises people, people always ask, well, do we need a big sales force? Or do we need to go hire third-party sales and distribution? And the reality is, because of what we just talked about, because the challenge is so acute, raising the first 100, 150 million, it is on your shoulders as the GP to go do it. A third party can't do it on your behalf, right? You have to tap into your network and investors who already know you and love you to go do it. And so that's the first challenge in contemplating a fund like this. And I think a lot of people have shown creativity in trying to solve for that. But that helps you get to bringing in outside capital much more quickly from investors who don't know you, if you've got a fund that's up and running and ready to go.
Yeah, I'd love to ask you about creative strategies that managers that are specialists in a particular area or an asset class have a track record, have demonstrated an ability to deliver, attractive returns on a risk-adjusted basis over a reasonable or preferably long period of time to their clients. So you have that, but they're sitting there listening to us have this conversation and saying, get to 100 million like in 12 months. I don't even know that many RIAs. Like, we haven't historically built relationships with independent advisors. I know a few folks that do it, but to go out and do it either on a local, regional, or national basis, like, they wouldn't know where to start. They've historically gone through consultants, or they've gone through family offices or high net worth to raise money. So I would love to have a conversation about what are some creative partnerships or seeding or strategic capital. You hear about this stuff on the private fund side. I'd love to ask you whether it's those examples or other creative strategies that managers can think about when sort of wanting to go into the advisor market or the retail market.
Yeah, I think the best idea that resonates, I think, well with GPs is we talk about de-risking an interval fund launch by backing up the timetable 6 to 12 months and creating a private fund for the express purpose of converting that into the registered fund at a later point in time. And so that way, I mean, you know, building a private fund is relatively fast and relatively cheap compared to a registered fund. And it's something that these firms know how to go do. But and that's called a conversion fund, because what you're communicating to investors, you know, it's in institutions, high net worth, RIA capital, you can raise capital among existing investors and try to target new investors in that fund, but everyone that comes into the fund knows that the end state is the interval fund. And the challenge, you know, and so that way everybody is on board with the plan, and you're able to successfully de-risk the launch of the interval fund, because you've already secured, you know, it doesn't have to be 50 or 100 million. You could keep going, you know, you could raise more capital. We've seen some very large private funds north of 250 million get contributed. So that just accelerates the capital raise that can be done in the interval fund marketplace. And so it's time well spent, even though, you know, and so we encourage people to kind of think about whether or not that's an option, because that way you're not spending a lot of time and money building an interval fund if this is the key component for a successful launch. And so I would say that's the best idea. Depending on the firm, other firms, you know, maybe they have family offices that they work with that are willing to be initial investors, and there might be some favorable economics that they can work out between the firm and those family offices. I've heard about that, because that's something that family offices are accustomed to, and so that's one option too. But each firm's a little bit different in terms of what's going to be the path of least resistance for them.
Yeah, it sounds like when I first heard, Kim, you say that, you know, there might be a year spent, like, after you have an initial conversation, managers sort of internally dialoguing about this before maybe they engage counsel to start, you know, beginning to write that prospectus. Now it makes sense, right? Because there's so many options really that the manager has to sort of think through, and different ways in which they could actualize, if you will, their strategy in the private wealth channel that maybe at first blush they just simply didn't even contemplate, because they got, you know, maybe bad advice.
Well, and I think too, what happens is we talk to a lot of head of business development, you know, or you're running investor relations at your alternative firm. You're already wearing 2 or 3 hats, and so the ability to make time and space to think through this whole other channel for distribution and this new product structure. That's why a lot of our clients will engage with us, because they have a BDC that they're launching, or they have another, you know, private fund that's launching. So there's you know, multiple priorities that take us off course. And that's where we're able to add bandwidth to a lot of these alternative firms. And I've got a team of 7 people who are entirely focused on product strategy and product development. And so you couldn't replicate that. You know, it's a similar size team to what I was running at Nuveen, heading up product development there. But it's this kind of expertise, and a lot of what people don't know is sort of under the surface. And until gone down the road, there's really never an issue that we don't think we can tackle. But part of the confidence that comes with that is just having the experience of addressing those issues as they pop up. And that's where we can, you know, help our clients, because it's an exciting opportunity, but it is, you know, there are a lot of challenges that are worth considering before you go down the road.
Yeah, and I think we both have experience. I more on the 40 Act mutual fund side, you across a variety of different registered offerings of the excitement of building, launching, having that effectiveness sort of from the SEC, and then 18 months later it's like a big thud, right? There's no new flows. You're writing checks to support the fund. It's painful. And ultimately, you have to make some hard business decisions because not every one of these is going to attract, like you said, the 2 billion, or in the case of Cliffwater, 20 plus billion. And they're going to have to make tough decisions about, do we continue to support it, et cetera. Last couple of questions I'd love to ask you before we wrap up around the sort of go forward regulatory posture. Retail investors increasingly are, I think, the focus of SEC and FINRA examinations around alternatives and the proliferation of alternatives. What's the I guess the posture of regulators around these product structures? Can individuals go and buy them, or do they have to be purchased through an advisor? Like, what's that conversation from a regulatory standpoint look like right now?
Well, I mean, I think the SEC is focused, on marketing related violations with the new SEC marketing rule, and that they don't want to see alternative products being advertised in a way that's inappropriate. And I think that's worth considering. Most of these interval fund products still need to be purchased through a financial advisor, which is,
Okay.
I think, a good aspect, because education is so important, understanding kind of the risk and the trade-offs, the lack of liquidity. And so that, while I would say probably 97% of interval fund sales are through financial advisors, either independent or wirehouse advisors, there is a growing number of alternative platforms that are making interval funds more accessible, sort of direct to consumer. And a few examples would be like SoFi, or Yield Street, or Fundrise. They make their interval funds available, through the web, and it does open up access to people without financial advisors. Now, like anything, I think it's really important to be thoughtful about the appropriate allocation. And a lot of the research firms have suggested anywhere from 5 to maybe 20% allocation to alternatives is appropriate. So we would also encourage some thoughtfulness, but people are using alternative credit as a substitute for traditional fixed income. Likewise, people are swapping out traditional long equity exposure for either private equity exposure or maybe for hedged equity exposure. So a lot of use cases. And I think we're going to continue to see innovation among fintech firms making these products more accessible than they are today.
Yeah, that's exciting because that's an area of fintech and retail distribution where I've spent a lot of time. And retail, means a lot of things. As we said, it could be independent broker dealers, it could be regional broker dealers, it could be independent RIAs. Now we have multifamily offices that are effectively, big institutions with sophisticated capabilities. Love to ask you one final question about distribution. What are some of the managers' biggest misconceptions about private wealth in general? When they think, I've been managing institutional money, don't know if retail really understands, or maybe retail we have the relationships, but what are some of the big misconceptions that you see most asset managers when they think about private wealth and this opportunity and this growing channel?
I think the two issues that I see, they're linked, because most interval funds start out being sold to RAs, to registered investment advisors, and that's a fairly sophisticated institutional like client. And the CIO at an RA is going to put the product through a fairly rigorous investment due diligence and sometimes operational due diligence process, just like a wirehouse gatekeeper might. And so I think that surprises a lot of alternative managers. They don't realize, I think they might think it's retail, so they might think that the hurdles are lower, but it's a very sophisticated buyer. And then the second sort of, I think, misunderstanding is that if you think that you're going out selling mutual funds, you think you need 20 salespeople to go sell the product, but that's not how these products are really sold. And so we've seen firms be successful, starting with one or two experienced. You needed someone with established relationships with those RAs or broker dealers, and somebody who understands alternative investments. So you don't need 20 wholesalers who are accustomed to selling mutual funds. Frankly, some of the larger mutual fund shops have had a lot of challenges getting their mutual fund wholesalers to be able to sell alternative products, because they're harder to sell than selling a muni bond fund or a large cap growth equity. So those are the two common misunderstandings. I think they think that it's going out to sort of dumb gatekeepers or advisors, and they're surprised at how sophisticated and institutional like these investors are. And then therefore, I think you need a quality sales team, and that could be 2 people, that could be 5 people, but you don't need 20 people. Even the market leaders in this market have relatively small sales teams if you compare it to a Nuveen or a BlackRock or some PIMCO, for example, who have hundreds of wholesalers. So those are, I think, 2 of the surprises. And this market is dominated. 70% of assets and funds are held by alternative managers, so firms that have never had a mutual fund or an ETF. And the likes of PIMCO or Nuveen, they are players in this market. And I like the fact that they educate a lot of advisors, but they don't dominate this market.
I really am encouraged by what I heard today, particularly for the CEFA members, some of whom I think will benefit from listening to this webinar, because I think what you said got me really excited. Was this is a more democratized space than some of the other asset classes and other strategies, where private funds, particularly, let's be honest, smaller, emerging, diverse, first-time managers, have really had their challenges to raise capital. And what we see as far as trends and flow, when you look at the data across just about every single asset class, and you even look at hedge funds, the largest managers are gobbling up the majority of the capital. And what I heard you say is, if you're thoughtful, if you have the requisite amount of time, if you engage the right partners, i.e., 7 professionals that this is all they do, you have a differentiated strategy. You don't have to go hire a gigantic sales force. Like, you build relationships with a private fund. Like, just encapsulating our conversation, there is there could be light at the end of the tunnel here. And that's encouraging. And that's really why CEFA exists, is to try to provide these educational forums to sort of advance the conversation. Because I think no one could deny that private wealth as a channel is growing. I think the numbers and data bear out that retail investors, whether you define those as people with $250,000 or people with $25 million to invest, they're under-allocated by and large to alternatives. Financial advisors don't want to hit the hard button. They want to hit the easy button. And that doesn't mean they're lazy. It means that they don't want the headaches, like you said, of K1s and subscription documents, and they want to allocate across a bigger piece of their book. So for all these reasons, understanding the opportunity here makes sense. Having said all that, I would love to give you the final word. How do we get in touch with you? What is the best way for a manager listening or other folks that are just interested in interval funds and tender offer funds, whether they be allocators or folks in this ecosystem? What's the best way for them to get in touch with you, Kim?
Sure. I mean, xainvestments.com. We've got a knowledge bank. We've got great white papers, which are written with the asset manager in mind. 10 Strategies for Success is one of the white papers I would point you to. We also have a monthly update. So we know these things take a while to percolate. So we like to drip on people and give them information about the growth in the market. So you can register on the website to get those monthly updates. And always reach out. We love talking with people, even folks that are really early in their process. It's much better to speak to us early than to get down the road, because we have had a lot of firms call us after they've filed with the SEC. And at that point, the problem is there's too much in the way of sunk costs, and thinking that we have yet to be able to kick save something that's that far down the road, partly because there's so many problems, and at that point people aren't willing to make changes to address them. So that's why we really like to talk with people early on, and while they're kind of thinking through if this is a viable pathway for them.
That's fantastic. Well, I'm going to make some public service announcements here momentarily. So I just want to thank you for being, our first guest on this CEFA webinar series to sort of advance the dialogue around important, relevant, and timely topics for our members and for prospective members. I thought this was a great conversation, and I look forward to hopefully having you down to Atlanta to some of our CEFA events, and connecting you with more folks in our ecosystem who want to learn more about XA Investment Services. So Kim Flynn, President, XA Investments, thank you for joining us today here on the CEFA webinar series.
Thank you. I appreciate it.
Yeah, it was great to have you. For those of you that are interested in learning more about CEFA events in the future, our next webinar will be next week on Wednesday, the 8th of May at 11 a.m. Eastern Time. We are going to be doing a digital assets webinar. That webinar will feature 3 institutional managers that are actively investing out of digital assets funds, a venture fund, a multi-manager, multi-strategy fund, and a long-only alternative token fund. I'd also like to point out that on July the 25th, a couple of months from now, is going to be our annual summer barbecue, and that summer barbecue will be in partnership this year with iConnections. We are excited to announce that partnership this summer, and so we expect this event will sell out. In the past, we've had 200 plus attendees, and with the iConnections partnership, we expect that those numbers will go up pretty significantly. And also excited to announce a number of other events that will be going on in the day before and the day of, in addition to our barbecue. So if you're from out of town and thinking about coming down to Atlanta for a couple of days, whether for golf, to visit family, friends, or for business, mark your calendar for July 24 and 25 for what we hope to build into Atlanta Alts Week in the coming years. With that, I'd like to thank you. I'm the president of CEFA. My name is Sandate. For more information about how you can get involved as a member or as a sponsor with CEFA, go to our website at www.thecefa.com. That's THESEAFA.com, and you can find more details. Thanks so much again for joining us today, Kim. I wish you the best in the remainder of the spring and in the summer ahead, and I look forward to us getting a chance to connect again soon.
Great. Thank you.
Thanks, everybody.
Bye-bye.
Bye-bye.